So if you subtract 2.402 from 2.968, you'll get 2.566. Again, as usual, you multiply by the 8,000, you generate the positive, in this case, present value score. You saw this last week. What you do then is you add those three positives, you'll end up with an answer, and you take away 20,000 and take away 17,860. The net result is the balancing of the negative and the positive, and what we have is a positive result. Now, the interpretation of that is simply that you've got yourself a good project, the cash inflows outweigh the cash outflows, the benefits are greater than the cost. These are the positive things, these are the negative things, but the positives outweigh the negatives. And we have a 3,167 positive. That means we've got ourselves a good project. What it essentially means is you're making more than 12%. So the important thing in this NPV process is it indicates to a company whether you are making more or less than the discount factor. If you end up with a positive NPV, it means you're making more than 12%. If this result was negative, I'd know I was making less than 12% per annum each year. If you got the unique situation that this was zero, that you ended up with an NPV of zero, then you'd know that the rate of return on this investment is exactly 12%. That's highly unlikely to happen. But if you got a zero score, that's really what we would call the internal rate of return. And that's what we're trying to do today. We're trying to find the internal rate of return. So what I'm going to do before I go on to indicate to you how you calculate the internal rate of return and try and understand what I've got here is an understanding that the return on this investment is greater than 12% because I have a positive NPV. That's all I know. Our next question is to find out what is the rate of return. Is it 14 or 15%? What is the actual rate of return? That's our next problem. But before I do that, I thought it might be useful, in case you didn't get a chance, to have a look at Project B. That's on your handout there. I think it's page 4 or something. I'm going to show you what Project B looks like. And I'm going to ask you to have a go at this question. And what we're trying to do in this question is calculate the net present value. Now, if you have your handout, you'll see Project B in that tutorial question on page 4. But the initial investment is 65,000. There's an extra bit of investment in year 1. And then you have an annuity in years 1 to 5. And then you have a cash inflow at the end of year 5. I'll let you read it for a few minutes. And what I want you to do then is try and calculate the net present value at a 12% discount factor. I will maybe show you the cash flows on a whiteboard to make sure you're okay with the nature of what the cash flows look like. But I want you to have a go at this question for a few minutes. Let me show you on a whiteboard. If you have the actual handout with you, this is what it looks like in the handout. We're looking at Project B here, this guy. So if you have the handout, it's just a case of reading that. And what I'll show you maybe on the on a whiteboard, what the cash flows would look like in the time frame. So let me just show you that on a whiteboard. Basically, what I mean by that is you'd put in the year and the cash flow. And as you read the question, you could see the initial year 0 is 65,000. So what we have is a 65,000 cost at the beginning of the investment. And then it says at the end of the first year, you need to invest another 6,000. So you have these kind of numbers. Again, these are in euro format. And you have a cost of 6,000 at the end of the first year. Then in years 1 to 5, there are many ways to design this, but as I read the information, I can see they have a cash inflow from years 1 to 5 of something like 18,000 euros. So on that basis, that's a cash inflow. There's no brackets around it. And at the end of the lifespan of the investment, they're saying to you that you bought a machine for 65 grand at the beginning. It's kind of a bit shook at the end of 5 years, but you could sell it to somebody. Another company would take that machine as a second-hand machine and use it for further production or something. But at the end of the day, they're saying to you that you can actually offload the machine or sell it. It's called a scrap value or the terminal value. You can get you can sell it for 21 grand. if you can sell it for 21,000, you get a cash inflow of 21,000. So really what I'm saying to you is that's one way of designing these cash flows. As you read, I'm writing them down. So I want you to maybe use that style. And so you have 65 at the beginning, another 6 negative at the end of year one, a cash inflow in the form of an annuity from years 1 to 5, and a one-off cash inflow at the end of year 5. The purpose of the question is to make sure you know which tables to use, and the appropriate discount factor in this case, we'll be using a discount factor of something like 12%. And your problem is to find the present value on the right. So I'll just give you a couple of minutes. You may have already done the question. If you have, relax. If you haven't already done the question, go to the back of the handout, look at the actual overheads. I should say, look at the actual discount tables, find the appropriate score, see can you generate an NPV. I'll give you, say, 5 minutes or so to see what you can come up with. Maybe bring you through this slowly because it's already up on Moodle from last week and you possibly have done this question before, but I just want to make sure you're okay with the NPV. The style, again, as always, you set up a time frame, a cash flow, a discount factor, and in this case, present value. That's my guy I'm interested in. So year zero is always in the present. That's, you're buying a machine for about 65,000 euro. That's today, not a problem. Be careful with the end of year one. End of year one is what's called a futuristic cash flow. We want to figure it in terms of year zero, time period zero. What could you effectively invest today at 12% so that in 1 year it grows to 6,000? The answer is 5.358 or something. This number comes from the discount tables. So I'm just making sure you're okay with the use of the discount tables. In actual fact, year one is the same in the annuity as the present value, but that's important that you're using the present value table there. The year 1 to 5, now again, you could have designed this differently, but year 1 to 5 is an annuity. It's not like year 4 to 8, it's not awkward. If it's 1 to whatever, you can just look up across from the number of time periods 5 and look directly underneath the 12% discount factor on the back of the handout, the annuity tables. You'll find 3.605. Multiply 3.605 by 18,000, you get the present value of that future income stream. And then lastly, we have a little cash flow to do with the fact that you have an old machine you bought for 65,000 that you can offload after 5 years use. You can sell it to somebody for 21,000. Now that cash flow occurs at the end of year 5. That's a one-off cash flow. I need to look up the present value tables because it happens one time 5 years from now. Essentially, 21,000 in 5 years' time is equivalent to 11,907 today if there's a 12% return available. Put that into an investment at 12% for 5 years compounded, it will grow to 21 grand. That's the present value. We end up with a result. I'm hoping that you got a result in around 6,439. That simply means that we have something that's viable because the positives, which are about 76,500, they beat the 70,000 odd by about 6,500. So the positives outweigh the negatives. We have more money coming in today's money value than we have going out in today's money value. Everything is in the present over here. So what it means is a good project, number one, but this is the important point. If the answer is positive, it tells me that I'm making more than 12% return on investment. So I'm getting more than 12%. If this was a negative score, I'd say I'm making less than 12%. The fact that it's more than 12% means it's a good project because the company's target rate of return is 12%. That's what that guy indicates there. It's also known as the cost of capital. It's our first problem. We're going to spend quite a bit of time trying to figure out what's an appropriate discount rate to use in an investment appraisal. But here we'd say it's a good investment and you're making more than 12%. Now that's the essence of what we did last week, that you know how to look up the tables. You know there's two different types of tables and there's a bit of calculation involved, and that if you get a positive NPV, you're making more than the discount rate annually. This leads on to the second question. And the second question is, I know that it's more than 12%. The obvious question is, well, what is the actual rate of return? To know it's more than 12% is useful, but you'd like to know, well, is it 13 or 14 or 15% per annum? What's the actual annual rate of return here? I know it's more than 12 because I have a positive NPV. And to make a decision on this, we need to show you the concept of the internal rate of return. That's what it tries to do. Now, again, to repeat, if I had got an answer of 0 here, then I would have known I was exactly making 12%. And that's what the IRR tries to do. It tries to find the discount factor, won't be using 12, but something that generates an NPV of 0. If I get that 0 NPV, I know the rate of discount is exactly the rate of return on the investment. That's the way it works. So I'm going to share a screen with you now to show you something new called the internal rate of return. Let's see how that works. So I'm going to bring you to the internal rate of return concept and bring you through this process. And we'll just do a couple of questions. We'll make sure you're okay with the tables and how to use a new formula, and then we'll be finished with today's session. So we're moving along. NPV, what do you know so far? You know the net present value indicates whether an investment is good or bad. What I mean by that is if you get a positive NPV, you'll say that's a good investment. If you get a negative NPV, that's a bad investment. What it really does is it tells you if you're making more or less than the discount rate. In the last example, I had a positive NPV. I knew then I was making more than 12% or something. This is where your man comes in, the IRR. IRR is what's called the internal rate of return. It's kind of self-explanatory. What's the internal rate of return? What's the rate of return in this investment? It actually indicates the return on the investment, the actual rate of return on the investment. It's a logical thing that people like to know. And in business, people like to know, what are you making? I'm making about 10% per annum, or I'm making 12%. What's the actual rate of return on the investment? So how to calculate this, fella? Well, the most important thing, and I can ask you questions to explain these concepts, but what is the point, or what is the actual purpose of the IRR? It tries to find the discount factor that gives you an NPV of 0. If your NPV of 0 exists, it means the cash outflows and inflows are balancing and yielding an exact rate, which is called the discount factor. So if I can find the discount factor that gives me an NPV of 0, I have my job done. And that's all we're going to do today. Make sure you know how to calculate an IRR. For some of you who've already done this before, but I'm just making sure you're all kind of at the same level. If you're calculating an internal rate of return, there's a couple of ways of doing it. If you use a computer, if you're using a laptop there, if you're in Excel and that, you can get it instantaneously. In an exam situation, you need to show a procedure. It's an approximation procedure. It doesn't give you an exact answer, but it gives you a very good approximation. So how do you do it? Well, it's a simple process, 2 steps involved. The first thing you do is you calculate 2 NPVs. What I mean by that is you'll use 2 different discount rates and you'll get 2 different NPVs. And then what you're able to do with these 4 pieces of information, that's 2 NPVs and 2 discount rates, you can input them into a little formula. It has a fancy title. It's called the interpolation formula. It's the internal rate of return approximation formula. And this formula has a lot of letters involved. Now, do not panic in any way. These letters and this formula is given to you at the back of the exam paper. And if you ever need to use it, it's available to you in every class situation and every setting. If you go to the back of your notes, you'll find the third last page has a bunch of formula. And one of them is what's called the internal rate of return formula. These letters have specific meanings, and on the back of your exam paper and also in the assessments and that, you'll be given the understanding of what each of the letters mean. So you'd have 2 discount rates, the little letters, the lowercase a and the lowercase b, they are known as the actual discount rates. So if you try two rates, one will be lower than the other, or one will be higher than the other. They're 2 different rates, so they're not equal, right? They're 2 different rates. So you need a lower and higher. And the capital letters in this little formula here are just the NPVs, the calculated numbers that turn out based on these 2 discount rates. So they'll be in money terms. The discount rate will be percentages, but the NPVs will be some kind of a money value, a euro value. So the capital letter A is connected to the little a. It's the NPV at the lower rate, and the capital letter B is the NPV at the higher rate. So they're first cousins, right? They go together. The easiest way for me to show you this in action is to show you an example question. So again, in your notes, now this formula is available to you, and the explanation is also available for you with any exam or assessment. It's available. You don't have to memorize any of this stuff. You're given this formula. But if I screen share you the handout that you have, and if we go to the next page, you'll find a little example of an internal rate of return on the next page. I have more or less put a question with full processes involved on that page there, page number 5. But let me bring you through this. I'll do this in an overhead format. I'll show you what we're doing here. We're looking at the NPV and the IRR. These are a made up bunch of numbers here, and I'm going to just bring you through the process. Let me show you what I mean by that. So in this example, we're going to look at a case of a series of little cash flows. And I got 2 questions here. I could easily ask you to do the first of these 2 questions, but you have the answer in front of you in the handout. Let me explain. Part A of this question is work out an annual net present value at a 12% discount rate. So what we have here, just to be familiar with this, I have given you no background to this. I'm making up a bunch of numbers, but suppose you have an investment that costs €75,000. You're buying a truck or a van or something like this, and you're setting up a transportation business, and you hope to generate cash inflow of 20,000 at the end of the first year, 30,000 at the end of the second year, and 50,000 at the end of the third year. But you have a situation where there's a cash outflow at the beginning, then a bunch of numbers coming in. And you're trying to work out what's happening here. Is it a good investment? Obviously, but that's what's called the net present value technique. It helps us to identify is this a good or a bad investment. So suppose you're borrowing from the bank at 12%. So you have to borrow 75 grand from the bank, and you have to pay 12% interest every year on it. You have to pay back the 75,000 at the end or something. So at the end of the day, this 12% is what's called the company's cost of capital, or its target rate of return. It has to make 12% to make it viable. We want to figure out, is there a 12% return here? Are we making more or less than 12%? The most important, or the more important of the two, is the red question: estimate the internal rate of return. Notice I use the word estimate because I'm not really focusing on an exact answer. I'm not using a computer. I'm going to use a procedure which will get me a very close approximation. So here, let's show you how it works. And you can see this on page 5 in your document. And apologies, I'm talking a lot here, but I'll bring you through this on page 5. First thing you do is you discount it at 12% and check out the answer. Let me show you that process. If you do this, the usual process accrues, right? You go through this process of calculating an NPV. Now, let me explain. There's the same old numbers. There's the time frame. These numbers are coming from what are called present value tables. 12%. And the 0.893, the 0.797, the 0.712, they're directly from a series of tables you have at the very back of your handout, second last page, present value tables. Notice the cash flows are different. It's not an annuity, they're individual one-off cash flows. Every one of them are different. But anyway, we discount each one of these and we get what are called a series of present values. As usual, you add up the positive numbers here. You'll see this, and all the calculations are in your notes there on page 5. You add up the positives, we'll get about 77,370 there, and I take away 75,000. I end up with 2,370. So what have I done? I've brought all these future cash flows back to what are called present values, discounting at 12%. I got a positive NPV. Two pieces of information come out of that. If it's a positive NPV, the positives outweigh the negative. This is a good investment. But the most important thing, if it's a positive NPV, we would say we're making more than 12%. If this was a negative score, I'd say I'm making less than 12%. If this was a 0 score, which is what I'm aiming towards, if this score had turned out to be 0, I'd know I was making exactly 12%. And that's what we're going to do next. We're going to try and find what discount rate would give you a 0 NPV. So what are we going to do next now? I've done part A of the question. You've figured out the NPV at 12%. It's positive. I'm making more than 12%. The next thing to do is to check out a second NPV using a second discount rate. Now, logically, it's more than 12%. So I should try something higher. So as the IRR, as the return on this investment is more than 12% because I have a positive NPV, I should try a higher rate. And in this case, I could try anything. I could try 13% or 14% or 15% or 20%. It doesn't really make any odds. And in an exam situation or an assessment situation, you could choose whatever you like. It's arbitrary. It's your choice. But logically, it's more than 12 because I can see it's a positive NPV at 12. I want to get that down to 0. So if I go higher, if I go 13 or 14, I have to make a decision here. So I'm going to try 14 for the crack, right? I'm going to try 14% as a discount factor and see what NPV is generated from a 14% score. Now, all that's going to happen here, your man up here is going to change to 14%. The 12% is going to change to 14%. And these numbers here will be again coming from a set of discount tables called present value tables, but I'll be using 14%. The higher the rate, you'll find the lower the value will be of the discount factor. So these numbers are going to drop down. What was 0.893 will be smaller. Same with this guy and same with this guy. So let me show you this, and it's all on page 5 in your handout. If I replicate the process, all that's happening now is I'm going to try 14%. Now, this is subjective. I could have tried 13 or 15 or 18 or 20. I'm trying something higher than 12. Here's your old 14. No change in year 0. Still 75 grand going out, time period 0 today. Watch what happens with the discount factors. What was 0.893 is now 0.877. It's dropped down. I have a higher rate, lower discount factor. So while that's really happening here, and you have this in front of you, and you can check the calculations, but essentially, these are the original cash flows. These are the present values with a higher discount rate. So these numbers all got smaller. And when you add up the positives this time, they don't quite make 75 grand. They're actually 74,360. So when you add up those numbers there, and then I take away 75,000, I end up with 640 negative. So what am I getting from this? I'm getting the fact that this is actually lower than 14%. If the NPV was again positive, I would have said it's more than 14%, but I got a negative NPV. So really, it's not critical that you get a negative NPV as a second discount factor. If you get two positives, the formula will work. I showed you a few minutes ago. If you get two negatives, the formula will work. It doesn't matter what you get. You just need to get two NPVs. But I can interpret this. I can say, okay, I got a negative NPV at 14%, so I'm not quite making 14%. If I'd gotten 0 there, I'd say the rate was exactly 14%, but it's negative, so it's a little bit less than 14%. So I now know that it's a little bit above 12 and a little bit below 14. At the 12%, I got 2,370. At the 14%, I got a negative 640. In layman's terms, I know it's kind of closer to 14 than it is to 12, because at 12, I was out by 2,300 odd, and at 14, I was out by 640 odd. The interpolation method is based on a linear approximation. So you're kind of just looking at a straight line format. Well, it's somewhere between the 12 and the 14, but it's kind of closer to the 14 than it is to the 12. The magnitudes of the NPV are indicating it's a little bit closer to the 14. So now we're going to use the old formula. That's our next problem. And watch what happens with the formula. Let me explain each of the variables here. And I know you have this in front of you on page number 5, but I'm just bringing it through in maybe a bigger print for you, where you can visually see it better on the overhead format. But the internal rate of return approximation, that's available to you. And an explanation of each of the variables. A is the lower discount rate. The little b, I should say, is the higher discount rate. The capital letter A is the NPV at the lower, and the capital letter B is the NPV at the higher. All of this is explained and available to you in an exam sitting. So what we got 12 and 14 as two rates. We got 2,370 euro and 640 euro negative for the two NPVs. Now you got percentages here and you got euros here. What I do when I'm applying the formula, I know the answer will be a percentage because it's a rate of return. It'll be a percentage rate. So I ignore all these things called percentages and euros. I treat them all like a bunch of numbers and I write them down. And this is what they look like. So your man, the little a, the lower discount rate is 12. I could put in percent there. I just call it 12. It's 12. It's 12 plus something. And then over on the right-hand side, we have the difference in the discount rates. Over on the right, the 12 is the little a and the 14 is the little b. There's your old 12 minus 4, or 14 minus 12, sorry. The capital letter A is the NPV at the lower rate, in this case, 2,370. It's repeated below the line on the left-hand side there in the denominator. And then you have a negative score, minus B. Be very careful. The minus B means minus the higher discount rated NPV. So minus, that is a negative 640. So you have a double negative here. You have minus, and in brackets means negative, minus 640. In maths, if you have two negatives coming together, it's a positive. So this reads 2,370 over 2,370 minus 640, which is effectively plus 640. Doesn't always happen. Just in this case, I have a negative for the B. So a double negative kicks in. So how do you do the calculation? Well, again, this is not a big deal for most of you, but be careful. I tend to break it into units. We've got a 12 on the left plus something multiplied by something. Do what's inside the brackets. 14 minus 12 is 2. And then do this calculation. You've got 2,370 over about 3,010. This is what it looks like. So your man there is 2, the 14 minus the 12. This guy, with the calculator, if you input 2,370 and divide it by about 3,010, you'll get 0.787 or something close to that. Again, what do? You multiply these two numbers. You multiply the 0.78 by the 2. It's about 0.8, about 1.6. And then you finally add it to the 12. So it's 12 plus these two guys multiplied. 12 plus 1.6, 13.6. I've ended up with an answer. The answer is telling you that the investment that I put up there earlier is making 13.6% annually every year. And that if you used a 13.6 discount rate, you'd have ended up with an NPV of 0. Now, notice the word approximately, because if I use 2 different discount rates, I might get a slightly different answer. You're still going to be in around 13 to 14%. It will give you an answer close enough to 13.6. So that's your first example of one of these problems. So what I'm going to do, if this makes, and I've been talking too long, I suppose, is give you a little question to have a look at, a little MCQ question, and see if you can generate an answer to this question and see if it works for you. Just hold on 1 second. I'll see can I get this little question for you. I'll put it up in front of you, an MCQ question. Okay, let me show you this question. Now, this is meant to be a relatively easy question, but just for a few minutes, if you'd have a look at it, you'll find, I think I have a bunch of multiple choice questions on page number 7, I think. So you have a series of little MCQs, and this is an example, and it's meant to be relatively easy. So just for a couple of minutes, if you could have a go and identify the use of the formula. I put the formula up for you, and it's available in the exam. You don't have to memorize it. And also the explanation of the formula is always available. Lower discount rate, higher discount rate, NPV at the lower, NPV at the higher. Anyway, see what you think. Just give you 2 minutes or so. It's meant to be a handy one. This is meant to be a relatively easy question. I hope you have an idea how to approach it. You have no background on the cash flows, but if you had the original cash flows and you went through the process of calculating the NPV at 15%, it turns out to be 50,000. You then know it's more than 15. I try a higher rate, and in this case, I tried something like 20,000, and based on the cash flows originally, we ended up with a negative 50,000. So I kind of know it's more than 15 and it's less than 20. What's interesting about this one, well, not that interesting, but basically the magnitude of the NPVs are identical. You're 50,000 plus at 15 and 50,000 negative at 20. So intuitively, you'd be kind of saying, well, it's kind of halfway between the two, in around 17.5%, your man here. But anyway, to go through the process, if you have mad numbers and it's not as easy looking as this guy, it's between the 15 and the 20. I just put in the information then. The lower discount rate was a score of, in this case, 15. And the higher discount rate was a score of 20. And then you have 50 positive for the actual NPV at 15 and 50 negative, but you have a double negative kicking in here. So as you'd expect, that turns out to be a half of 5, just 2.5 on top of 15, 17.5. I hope you're okay with this. But the end result here would be you go with B as the solution to the question. So that was kind of intuitively, you'd have an idea it's halfway between these two LEDs because the magnitude is the same above and below, in around halfway between 15 and 20. Let me give you one more little example and then we'll take a break. So the next little example is another MCQ. And this, again, all of these overheads will go up on Moodle for you, so don't panic if you're having difficulty taking note or if you haven't got the notes in front of you. But if you look at the next example, it's another MCQ, just the figure's a little bit more awkward, but you should have a good handle on how to approach it. If I show you this next MCQ question, let you give you another maybe 5 minutes for this or something. Just make sure you're okay with this. Again, you will be given the formula in the exam. It's not something you have to memorize or anything like that, but just if you're cute and use the information. So just give you a couple of minutes, 3 or 4 minutes. So I'm going to give you a little bit of a run through the solution to this one. I know I'm going kind of maybe fast. I don't know. I need some feedback from you to tell me if things are too difficult or too easy. But anyway, the point is this. You don't have the original cash flows. It could have been a lot of years or something, but you've got an information piece here. NPV of 12,000 positive at a discount rate of 12%. So now you know it's more than 12%. So you can drop kick 6.5 anyway. And an NPV of 6,935 negative when you use a discount rate of 22%. So it's lower than 22%. You can drop kick your 28.5. Estimate the internal rate of return. So it's somewhere between 12 and 22. bit closer to the 22 than the 12 because I'm 12,000 positive at 12 and 6,000 negative or 7,000 negative at 22. A little bit closer to the 22. You could probably guesstimate it as well. But anyway, let me show you. Put in the numbers here. The numbers, as you read them, lower discount rate, higher discount rate, NPV at the lower, double negative kicking in here for the NPV at the higher rate. That minus B is a minus 6935, hence the positive score. So what you'll end up here is about 10%, and what you'll have here is 12,500 divided by whatever, 19,000 or so. So if you do the maths on this thing and you use your calculator appropriately, you'll get an answer here of about 0.65. You'll get an answer here of about 10. 10 by 0.65 is 6.5. Add it to 12. The last thing you do is you add it to 12. So it's 12 plus a bunch of calculations. You end up at about 18.5, and there's your man. So it's answer A. Now, at the end of the day, we're just going to bring you through a couple of examples. I'm going to bring you through a couple of examples of how to calculate internal rate of return from scratch. So I'm going to take a break, if this is okay. I'm going to take a break for about maybe 15 minutes or so. So it's now touching 5 to. So if we start again at 10 past, if you want to ask a question, all you got to do is unmute and ask a question, or if you want to put something in the text box, if you want to chat in the chat box or whatever it is, if there's something difficult with what I'm doing here. But for the moment, we're going to take a break for about 15 minutes and come back. Just going to go for a coffee or something, and you can decide. That's my plan anyway. But please ask if you have a question. If I'm going too fast or going too slow, I got to go with to bring everyone to the same level. So I'm hoping it's reasonably paced. But please, if you have any difficulty, put something in the chat box or unmute and ask a question. No problem. So we'll chat to you in about 15 minutes or so. See how we get on. Should take a half an hour for the rest of the session. Talk to you soon. So I'm going to start again in a minute, I suppose. Can you just maybe indicate to me that you can understand what I did so far? If I get a thumbs up or if there's a thumb down, I can figure out what the problem is. Are you able to hear me and see the overheads perfectly? Thanks, guys. I hope this is okay. The purpose of the exercise is just to make sure you're comfortable with these techniques. Thanks for the thumbs up. At least I think you're understanding it. That's the main thing. And don't panic if you're not. You have plenty of time from one week to the next to practice questions and have a go at things. So what I've done is I've shown you one example of how to calculate an internal rate of return. And I've also shown you a couple of little MCQs to practice the little use of the formula, which is this interpolation formula with the A's and B's and stuff. What we need to focus on now is maybe just doing a couple of examples. We'll just do maybe 2 examples. It won't take too long, and then we'll stop. And then when I begin the cost of capital area, I'll sometimes have to ask you to do a calculation, like calculate an internal rate of return. But we'll get to that when we begin. Most important thing anyway, just show you a few examples of how to to calculate an IRR. I'm going to give you a little example, a small one with an annuity, and then we'll have a look at that project A we did earlier on today from your notes, and again try and calculate an internal rate of return. So I'm going to screen share you with where we stopped, a multiple choice question, and we'll maybe just bring it to a situation where we're looking at an example you could have a practice on. Okay, we just did question 7 there. We just had a go at that one. On page 7, sorry, that IRR question. Now I'm going to show you another question. And what I'm going to ask you to do, this is taken directly from your notes. In your notes, you would have had a question on, I think it was page 4. And at the top of the page, you'd have this set of information and calculate the net present value with an 11% discount factor. It's one we did last week. So what I'm going to try and do now is get you to do a calculation of the internal rate of return. This is what we did last week. You might remember the question. It was an easy enough one, I think. The whole idea, my purpose last week is just make sure you know how to get this little discount factor. You look at the back of the handout, second last page, you're looking at the annuity tables and you're focusing on 11% and period 1 to 5. What happened here, we got an NPV of 1568. Now that just simply means I'm making more than 11%. So the interpretation there is that we have something higher than 11%. Now what I need you to do is to calculate the internal rate of return. To make the decision as to what the second discount rate is, it's simple. If the NPV is positive on the first calculation, then we know it's more than 11%. So logically, I should try a higher rate than 11. Now you can try 12 or 13 or 14 or 15 or 16, whatever you want. It really doesn't matter to me. But I should try something higher than 11%. And when we calculate the internal rate of return, I just need 2 sets of information, a discount rate and an NPV, and then a second discount rate and a second NPV. But logically, you should try something higher than 11. For me, I have to show you the example. So I'm going to choose a rate of around 15. You don't have to choose that rate. But I'll work on that principle that I'm going to try a second rate, say something like 15, and I'll wander through the solution to the problem. But you could have a go there for about 5 to 10 minutes, just 5 minutes maybe. See, could you work out, try another rate, anything you want. It doesn't have to be 15. But depending on what you use, you'll get different NPVs. But the important thing is then using the interpolation formula to generate the approximate IRR. So have a go, see what you think. Okay, I'm going to maybe bring it through the solution to this, unless somebody wants to offer me. Anyone get an answer on this one so far? I can bring it through it anyway and show you with an example of 15%, but I'm hoping you should all get slightly different answers depending on the rate you've chosen. But depending on what you chose, you should all get very similar IRRs. Let's see what happens. If somebody has a specific problem at the end of the session, maybe you can show me your workings and we can work through it. But I'm going to go with 15%, and the usual routine would apply. I'll end up with the same layout, but I'm using a 15% discount factor. So the year zero, no problem. It's the same old story, 28,000. And now I chose 15. That means I go to a set of tables. Notice what happens. If you choose 11%, I get 3.696. If I choose 15%, I get 3.352. So the higher the rate, the lower the discount factor. All that does is reduce the value of the present value. The higher the rate, the lower you'll end up with a present value format. It actually turns out to be a negative score for me. Now, you may have chosen 12% or 13%, and that would lead to potentially another positive. It doesn't make any odds. You just need 2 NPVs. Now, I got a negative one. So I'm going to go with my numbers here. And if I go with the information I have at this stage, this is the set of information I have. Now, yours will be different. Like if you chose 12%, you would have got a positive NPV. 13%, probably just a bit positive. After that, you're heading into negative territory. If you chose 20%, it'd be a large negative, depending on what you chose. But I have 2 rates, 11 and 15. I got 2 NPVs. One positive, one negative. It doesn't have to be that case. It could be 2 positives. It still work. But I just input them into a formula. And notice what's happening again. I don't use the percentages or the euro format. I'm just a bunch of numbers here. Difference in discount rates, 4. 11 plus something multiplied by 4. If you use your calculator, I'll end up with around 0.57 or so multiplied by 4. I'll end up with about 2.3 or something. So my end result was about 11 plus 2.3. Make sure you do this calculation and then simply 11 plus that calculation. Now, sometimes it then turns out to be a negative here. It depends on the information you have input. But in this case, I'm getting about 13.3. I hope. Now, you may have got 13.7 or 13.2, or I don't know what you got, but it shouldn't be a million miles away from the answer I have. This is an approximate answer. It's not an exact answer, but everyone gets different answers depending on the 2 rates they chose and the 2 NPVs they calculated. But you should be talking in around that sort of score. So what I'm going to do now is focus on the question we had earlier on. And that was a tutorial question. And once we get through this question, I'm reasonably happy that unless you have questions for me, that you know how to calculate what's called an internal rate of return. So today, we calculated the net present value of Project A. Project A is on page 4 of your handout. So if you look at page 4 of your handout and you focus on Project A, we went through this earlier on today. This time I'm going to ask you, given the information we had previously, can you work out the IRR? So I'm going to show you what our result was. And it's the result from earlier, when we started around 12 o'clock or so. Here's the result. So this is what you got. And these are the numbers that we kind of generated. So this is the interesting part. Project A had a bunch of old cash flows. This was a bit of grief here. You get your 4 to 8. And I explained how to do that if you're using the annuity tables. But we got 3,167. So what does that mean? It means the rate of return on this investment is greater than 12%. That's all it means. So I'm going to ask you in your own time to have a go and see, can you calculate what's called the internal rate of return? Now, logically, when you choose your next rate, it should be something higher than 12%. So depending on what you choose, you'll get different IRRs. So for me, I'm going to, again, use something similar to the last example, but you can choose any rate you want, but it logically should be higher than 12 and see what happens. And if you're reasonably okay with this, we won't do any more than this today. It's just a case of making sure you know how to use the tables, what tables to use, how to calculate an NPV, how to calculate an IRR. So see, can you generate an internal rate of return based on the information in front of you here? And I'll put this up on Moodle. I'll put all of these overheads on Moodle later on for you. but we've done a good bit today. So we'll give you a little bit of time. And again, please, if you want to turn unmute, or if you want to put something in the chat box, please do. So on the basis of what you have here, can you calculate the IRR? I'm going to bring you through what I've done here and see if you're okay with what you have done. If people are having difficulty at the end, just stay on a little bit. Maybe if you want to ask a few questions or you want to share something with me. I had to decide a second discount rate, and I chose, like before, because I'm lazy, I chose 15%. It didn't matter what I chose. I could have taken 13 or 14 or 15 or 20 or whatever. It doesn't make any odds. The main thing is I need a second discount rate and a second NPV. And it is not critical that I get a negative score for the NPV. For illustration of doing this, but I could have taken any rate and got another positive. The formula will still work. So I chose our second rate, and the rate I chose in this example was just 15% again. It doesn't make any odds, but the routine then would be I'd do the same thing with these cash flows. I would discount at 15%, so it's a different rate. These numbers will all change. So if I bring you through the process, now you may have chosen 13 or 14 or 18 or whatever, who knows? So obviously you may not have the same numbers as me, but let me show you what I got, and then we'll go through the process. I tried a higher rate of 15. As I say, it's an arbitrary choice. It could have been anything, but logically higher than 12 because I knew it was more than 12. Let me explain. No problem with the year 1, year 2, and year 3. They're all just a new bunch of numbers from what are called the present value tables. And then I had to work on a year 4 to 8. And in the same way I did this before, I will use 1 to 8 and take away 1 to 3. I need 4 to 8. I want to include 4 and 5 and 6 and 7 and 8. Now, if I do this, I'm going to show you the answer real quick, but then I'll focus you on the actual calculation of that 4 to 8 discount factor of 2.204. Now, yours could be completely different depending on the second rates you used. But the bottom line is if I go 1 to 8 at 15%, this is from the annuity table, I'll get 4.487. I want to exclude years 1, 2, and 3. I want to get 4, 5, 6, 7, 8 and include 4, but exclude 1, 2, 3. So take 1 to 3. In your annuity table, you'll get 2.283. If I subtract the first 3 years from the first 8 years, I will get the years 4 to 8. So you take away the first 3 from the first 8, you'll have in time value, you'll have years 4 to 8, and it turns out to be 2.204. Now, when I use that 2.204 in the calculation, I multiply it by 8,000, I get this present value. I have 3 present values. They're much reduced. I add them up. I take away 17,400 and take away 20,000. At the end of the day, I end up with an answer. The answer in this example is negative, and it's not that big. So I know I'm fairly close to 15%. If the answer was 0, it would be 15%. It's a negative answer. It does not have to be negative. I stress this. It doesn't have to be. You just need to have 2 rates and 2 NPVs. So what I'll do then is I'll use the formula and I'll put in the 12 and the 15 and the information I got earlier. So these are the information pieces I have, 4 little parts to a puzzle. So I have a lower rate of 12, a higher rate of 15, at 3,167 for the capital letter A, above and below the line, and a negative 532. There's a double negative kicking in here, so I'll have a plus 532. This is my solution. Yours may be different, but this is what mine looks like. The 12 is the last thing I look at. I do the calculation in the brackets here, 3. I do the calculation here, 3,000 over about 3,500. If you get 3,000 over 3,500, you get about 0.856 or something, approximately. That's the 3 decimal places. I just simply multiply that by 3. Forget the percentage if you want for the moment. So 3 times 0.8 or 0.85. You'll get about 2.4, 2.5, 2.6. And you'll add it to the 12. So you get about 2.6 plus the 12, 14.6 approximately. Now, you may not have got the same answer. You may have tried 13%, got a positive NPV, or 14% got a positive NPV, or 18% got a negative NPV. I don't know. But the most important thing to understand is you just need 2 rates and 2 NPVs and input into a little approximation formula, and it'll give you an answer. Your answer should not be too far away from this. You might have got an answer 14.8 or 14.3. You may have even got 15 point something, I don't know, but it shouldn't be too far away from 14.5% or so. And if your answer is reasonably close to that, then you understand the process of calculating an NPV and, more importantly, calculating an IRR. The NPV is used primarily in investment appraisal, which we do later in the year. The IRR is used in the concept of cost of capital and investment appraisal. But in the cost of capital area, I'm very interested in you understanding how to calculate an internal rate of return. The routine is always the same. Once you have your cash flows, you need to try two rates and then use a little formula. So we have more or less finished what's called the background, the discounted cash flow techniques that are necessary for the course right throughout the year. And if you have a question, I'll gladly answer it. I think I have one question here. I'll just check. But if you have a question, please ask and I'll try and help you. So somebody here has used 20% and they found a 14.9%. The reason why you get a different answer to mine, it's never going to be the exact same answer unless you use the exact same two rates I used. If you use 20%, that's perfect. And if you got an answer of around 14.9, it's perfect. I have no problem. It is an approximation. You should be hovering somewhere around 14 to 15%. So your answer is perfect there. Don't worry about that, Hugo. It's all good. If you have any other questions or you want to actually communicate and talk to me about anything you're having difficulty with this, please do ask, because I'll stay for the next 5 or 10 minutes. But the session is over. The lecture is complete. I am happy that I've gone through the use of tables, the calculation of NPV, and the calculation of IRR. And next week we start cost of capital. You're about page 5 or 6 into your notes there. And we're just making our way right through those notes over the course of the whole semester. So I'm going to start cost of capital with you next week. I'll stay on for a few minutes in case you want to ask a question or you want to communicate. If you want to chat in the chat room, or if you want to unmute and ask a question, please do. And I'll stay for a few minutes. But the rest you can head off and chill, have a lunch or something. I'll chat to you next week. Take care, Paul.